Guys, today we're talking about the sharing economy and your property, particularly focusing on Airbnb. So let's talk about everything you need to know about rent expenses and capital gains. 3, 2, 1, let's go! So welcome back to the video. So today we're talking particularly about Airbnb and the sharing economy. So I just know with a lot of people, when you go to book your accommodation now, you're just you're going to straight to Airbnb. And for those who are out there and they might be thinking, well, how can I make a little bit of extra cash in my home, renting out maybe downstairs or a bedroom or even like a particular part of the house, this video is for you. So the first thing we want to consider is rental income. Okay, so it's really important that the rent you're charging is at a commercial or market rate. And the reason this is because when it comes to claiming tax deductions, you're only going to be able to claim 100%, I guess, of the whatever the expense may be if you're charging a commercial rate. So as a side example, getting away from Airbnb, if you were renting out, say, your house and you give your to a friend that you know a 10% discount, right? So instead of them, I guess effectively they're only paying 90% of the market rent. When you come to claim your tax deductions on that rent you're earning, you're only going to be able to claim 90% of the allowable deductions. So that would be 90% of the interest, 90% of the rates, the council rates, water rates. But yeah, so this is something we've really got to consider when we're looking at, I guess, the whole picture of the rental schedule for your Airbnb property, or even just rental property in general. Second thing we want to look at is rental expenses. So this is on the basis that I guess what I want to focus on today with Airbnb, it's on the basis that for most people, if they're only renting out part of the house, this is probably really for you. So let's say you're only renting out downstairs of your house. There are going to be some expenses that are fully deductible for you earning that accessible income from Airbnb, for renting out part of your house. So typical expenses that we would claim would be like the fees that Airbnb charge, or the advertising costs to get people in there to rent your downstairs of your house. Other expenses could be like cleaning fees or repairs made directly to the area that was rented out. So if a person staying there damages a piece of furniture, but we could claim that repair. There are some expenses that you will incur that will be only partially deducted. So, as an example, if we were only renting out downstairs of a house, right, and that came to say 50% of the total space in the house, so the total floor space was only 50% was rented out, being downstairs. Well, we're only going to claim 50% of, I guess, or of partial expenses. So, say for example, rates, council rates, water rates, strata. Right, we're only going to claim 50% of those. Utilities, insurance, interest on your home loan, only 50% would be claimed. And I guess the same thing would be if, say for example, you were only renting out a bedroom, right? It might be that the bedroom represents 15% of the house, and there might be, if they're renting out, say you're renting out that room and they can still use some common area in the property, which might be, say, the lounge room and the kitchen. And, we might say that the lounge room and the kitchen is 50% of the entire space of the house. So because you've got that person using half of that property with your family, we would say, well, okay, 25% is what we're going to claim there, and we've got 10%, which is the bedroom, so we're going to claim 35% of the allowable deductions on, say, for example, council rates, water rates, interest, insurance, and even things like maybe the internet or utilities like the electricity. Okay. The next thing as well is there's going to be some things that just you can't claim. So anything that's really in your private area of your house. So, you can't go claim, I guess, repairs or maintenance done to your own private bedroom, or I guess buying furniture that doesn't relate to the space that's being rented out. Okay, so whatever we're claiming as a tax deduction, it always needs to relate back to the assessable income. And if it doesn't 100% relate back, we are going to claim that pro-rated percentage that it relates to. As another thing to consider is depreciation. So there are some things that we won't be able to claim 100%, fully in the 1 year. So we want to really sort of determine, well, how much of the house is being used by that person who's renting out the room or part of the house, right? And then we're going to use that percentage as an application against certain tax deductions. So the ones I just mentioned, but then also things that we're going to depreciate. So there's capital works, so we might be able to claim the building of the cost of the house, and the previous video I talked about Division 43, or the 2.5% building write-off. So I suggest you go back and have a look at that video, which will explain what capital works in Division 43 actually is. But once again, when we're applying Division 43, we're only going to claim a percentage. So in that case, if we only did half the house, only half the depreciation is going to be claimed in that year. Look, there are things that you can also claim. So if you went and bought a TV for the house that you were renting, half the house you were renting, well, we could claim that over its useful life. Things like, carpet. If we replaced the carpet, there was brand new carpet during the period we were renting, we could claim that as well. But once again, over its useful life, which is, I think, 10 years. Furniture and appliances. So, if you went out and bought special furniture for this rented out space, well, once again, that could be claimed over a number of years. But if that furniture was only being used in that rented space, well, we could definitely claim 100% of it. So that really covers off, I guess, the rental income, the rental expenses, and the next thing I want to talk to you about is capital gains. Okay, so the third thing we've got to really consider is capital gains tax. Because the reality is, at some point you're going to sell your house one day. And if you've been using Airbnb or something similar to Airbnb, there is going to be capital gains tax to consider. Okay, so even if, say for example, you only did it for a few years, and then years later you sold the house, well, there's still going to be a capital gains tax calculation. But before we talk about capital gains, let's just speak very generally. As an individual, if you do have, I guess, your home that you live in, you don't rent out. So if you don't rent it out, you do fall under, I guess, your house being part of your main residence. And there is an exemption that basically that if the house was your main residence for the entire time you owned it, and it was not used to produce assessable income, there is an exemption where there's no capital gains tax on whatever you made. So, your family home, if you bought it 10 years ago for $1 million and you're lucky enough to sell it for $2 million, the house is worth $1 million more than when you bought it, well, there's no tax on that, right? On the basis that it was your main residence, you never rented it out, and it was not used to produce assessable income. If you need to, there's a video from last week where we talked about the 6-year exemption rule. So I suggest that you have a look at that if you want to know a little bit more about capital gains and your primary residence. A second note as well that really we want to cover off, and I've talked about in previous videos as well on property and capital gains, is if you're, regardless of what you've done with the house, if you rented out or not, or you've been your main residence the whole time, if you bought the house before capital gains tax was a thing, so before the 20th of September 1985, you're not subject to capital gains tax. And look, don't turn off the video now, still watch, but essentially, everything I say after this, you don't have to worry about. So because there'll be no capital gains no matter what you do. Okay? But if you're like most people and you bought your house after 1985, this is going to be important to know if you're doing Airbnb or something similar, because then capital gains will apply. But it's going to be, especially if you're not renting out the whole house and it's only on a percentage that you're renting it out. So we go back to my 50% of the house being rented out. It's going to be, the capital gains tax is going to be on a prorated basis. So only a proportionate basis of the total space rented out over the total space of the house is going to actually be subject to capital gains tax. How we calculate that capital gain is actually pretty simple. From the day you go and rent your house out as an Airbnb property, and you can do this after, it doesn't have to be done the day of, but you want to actually get an evaluation done on your house to determine how much it was worth at that point. Now, you can do this test yourself, but I would actually strongly advise that you get a registered valuer to register the property, so to actually give you a valuation of what it's worth. And if you're watching and you think, oh great, I've got to know a really good real estate agent, well, that's a great way to indicate, I guess, how much property's worth, but it won't hold up for ATO purposes. So you need to get a registered valuer. So if you don't know anyone, please reach out to us, but otherwise even your local real estate agent will know a registered valuer. But it's really important to do that because the ATO loves tackling or challenging the value of a property, right? Because it means basically they might say, hey, it's worth more, it was worth a whole lot less or more, whatever, which could actually, be subject to the tax or the gain being, significantly higher. So that's the first thing. So the day one you go and rent out, we get an evaluation done on the house. So we know what it's worth. And that's going to be what we call our cost base. So if I started doing Airbnb today and my house was worth $2 million, for example, we ignore the fact that, maybe I bought it 10 years ago for 1.5 or 1 million, whatever the price might have been. We don't care. We only really care at day one where you started renting out what it was worth at that point. And that's going to be really valuable to know. Because when we work out your capital gains, and let's say the whole time for the next 5 years you did Airbnb, and 50% of that house was being rented out. So the way it would work basically is that we would say, well, all right, let's say in 5 years' time we sold the house for $3 million, right? And the day one, at the moment, is worth $2 million. So in 5 years we've made essentially in the whole house $1 million. But if we go back to my example I've been going on about with having the house downstairs rented out and it's only 50%, that also means that only 50% of that gain is going to be taxed. So the usual capital gains calculation happens where we sort of look at all the selling costs and all that sort of stuff, and we come down to that figure of what you've made and what the capital gain actually is. So in this example, it was $1 million. We would multiply that by 50%, and only $500,000 would be the gain that is assessable. And then we apply the usual rules of capital gains. The house has been held for more than 12 months, so therefore there's another 50% discount, which means only $250,000 is taxed. And then, we apply the rules of, I guess, tax at a marginal tax rate. But I guess the important thing is knowing that how to calculate that and what tax you're going to possibly have in the future. Because at the moment, if you weren't renting your house out and you sold it in a few years' time, there'll be no tax at all. Just to add a little bit more complexity, if, say, for example, your house, you've been renting it out for Airbnb every 5 years, and you live at Cronulla Beach, and it's only really 6 months a year you rent your house out. Well, just to add to that complexity, we'd be multiplying that by another 50%, because of that whole time, you've only really been, half the year renting it out. And that would also go back, if we go back to the expenses, we'd only be multiplying, we basically taking that 50% and then multiplying it by 0.5 or 50%, which would then mean only 25% during the year is claimed. So it can get quite complicated. So even everyone's scenario for an Airbnb property is going to be a little bit different. So what I do strongly advise is that you reach out to an accountant to assist you in working out how your scenario is put together and how it works. So that's Airbnb. That's the sharing economy, and on a tax perspective. If you've got any questions, please reach out. You can find us at ngraccounting.com.au. Happy to chat, happy to help and talk, and see how we can help you. Thanks guys for watching. Catch you next time.